Good morning friends, good morning everyone, and welcome to this marathon, and hope you are preparing well. So what is that I am going to cover in this marathon is that I'll be first discussing few important concepts, and I have already shared that PDF with you as to what are all the important concepts that you must be knowing. Okay, so already I shared that PDF in Telegram and everywhere. So those important concepts which I am going to discuss. Okay, so this in the first concept is related to refund subject to unjust enrichment. There is one point which says that whenever we are making application for refund, we need to prove that. So there is a principle of unjust enrichment, that is, we have not transferred the burden to the next person. How to prove that refund is subject to unjust enrichment? Either a declaration needs to be given stating that we have not transferred the burden to the next person, or we need to get a certificate from a CA or CMA. Now here what we need to understand is that if the amount of refund exceeds 2 lakhs, we need to get a certificate from CA or CMA. If the amount does not exceed 2 lakhs, then a declaration to be made. But in some cases, neither declaration nor certificate is required. What are those cases? That is this: refund of IGST paid on export of goods or services. So whenever we are making export of goods or services, there are two options: export upon payment of IGST and get refund of that IGST, export without payment of IGST and get refund of ITC. In that, export upon payment of IGST, so of goods or services, we don't have to prove unjust enrichment. Then refund of unutilized ITC. What are the cases where we get refund of unutilized ITC? Zero rated supplies. Zero rated supplies is export of goods or service, or supply of goods or services to SEZ, or inverted tax structure. That is, the tax rate on outward supply is less than the tax rate on inward supply. So in that case, then refund arising on account of refund voucher. So whenever advance is collected, based on advance we will be giving a receipt voucher, and if it is services, on advances already we would have paid GST. In case of goods, we will not pay GST on advances, but in case of services we will pay GST on advances. Now whenever the advance is refunded, so we will be giving a refund voucher to the recipient. As and when we give refund voucher to the recipient, so we can get the refund. So in that case also no need to prove unjust enrichment. Then refund on account of wrong classification, treating intrastate supply as interstate supply and vice versa. So we need to pay the correct tax and get the refund of wrong tax. And one student asked me this doubt: what is the difference between this refund versus PMT9? PMT9 is before making the payment itself, if I know that so it is intrastate treated as interstate or vice versa, so that what I will do in cash ledger, I will shift the balances from one cell to another cell by filing PMT9. Suppose once the tax is paid and thereafter I came to know that it is wrongly classified intra as inter or inter as intra, vice versa, like that, then in that case the only way is to get the refund as per section 77. So we need to pay the correct tax and get the refund of wrong tax. In that case no need to prove unjust enrichment. Then refund of excess balance in the cash ledger. So whenever we have some excess balance in the cash ledger, we don't have to submit any declaration or certificate. Even now there is an amendment: refund claimed by an unregistered recipient. So even recipient, because any person can claim the refund, even unregistered recipient also can claim the refund, and unjust enrichment is not applicable in this case. So these are the 6 cases where unjust enrichment concept is not applicable, means neither declaration nor certificate from CA/CMA required. Then there is one important amendment here related to how the refund will be claimed by the unregistered recipient, and when in that situation the refund will be applicable. Say supplier can issue a credit note. Supplier has raised the invoice and supplier cancel the transaction, or recipient cancel the transaction. In any case, supplier can issue the credit note to the recipient, but supplier could not issue the credit note, or supplier could issue credit note but the time limit for issuance of credit note is over. In that case, supplier will retain the GST, so which means supplier will not get any benefit, but there is a burden on the recipient. Now recipient can get the refund. So how recipient can get the refund? Supplier will be giving a letter of cancellation of supply. Based on the letter of cancellation of supply, recipient can submit that as documentary evidence and he can get the refund. So 2 years from the relevant date. What is the relevant date? The date on which the letter is given or the supply is cancelled. From the date, within 2 years they need to make refund application, and this refund subject to unjust enrichment is not applicable in that case. So this is one area. This is there in page number 149, which is an important concept. It can be tested for theory. So you may get a question, what are the cases where refund subject to unjust enrichment is not applicable, like that they will ask. So these are the cases. And what will happen if we are not able to prove this, that is neither declaration nor certificate is given in other cases? In these cases you don't have to give anything. In other cases, suppose if you have not given any declaration or certificate, what will happen? The money will be credited to consumer welfare fund. Then next in exemptions, so we have renting. So renting a few services I have identified that it can be tested in exam this attempt, so that's why I'm discussing this. So renting of movable property, immovable property. In case of renting of movable property, we have 4 exemptions. Hiring of motor vehicle that can carry more than 12 passengers to a state road transport undertaking, hiring of vehicle that can carry goods to a goods transport agency, hiring of electric vehicle that can carry more than 12 passengers to a local authority, but it's an electric motor vehicle, then hiring of bus to a person who in turn provides services, transportation service to educational institution up to 12th standard or equivalent. These 4 cases it is exempted. In other cases, renting of movable property will be taxable. What about immovable property? In case of renting of immovable property, first land. In case of land, upfront charges including preferential location charges. In case of long-term lease of land, long-term lease of land means lease for a period greater than or equals to 30 years of industrial plots or plots for development of infrastructure for finance business by state government industrial development corporation. So this is one exemption. Then in case of building, we have residential property given on rent for unregistered person will be exempted. And what if it is given on rent to a registered person? See, first commercial property will be always taxable. Renting of commercial property, renting of residential property for commercial purpose also always taxable, and it will be coming under FCM. But renting of residential property for residential purpose, divide into 2. To unregistered person exempted, to registered person will be taxable under RCM. But we have got one explanation now. What is that? If it is given on rent to a registered individual for family stay, then it will be exempted. Otherwise, so any other registered person, it will be taxable under RCM. In the latest MTP of ICI, so they have given this point, but they mention it as FCM, but actually that is wrong. It should be RCM. Like renting of like furnished apartment to ABC Private Limited. So ABC Private Limited will pay GST under RCM. It's not the person, supplier will pay GST. Then next, renting of precincts of a religious place meant for general public. So here accommodation, for accommodation, that is a religious place. The precincts of the religious place is owned by a trust, and they have given that precincts on rental basis. For what purpose? For accommodation or for hall or for shops. If it is for accommodation, remember less than 1000 rupees per day. It's not less than or equals to, it is less than 1000 rupees per day exempted. In case of hall, less than 10,000 per day exempted. In case of shops, less than 10,000 per month is exempted. Then GTA services, we have only 3 exemptions. So there are some specified goods. What are those specified goods? So 6 specified goods: agricultural produce, food grains including flours, pulses, milk and salt, organic manure, newspapers and magazines, defense or military equipment, relief material for natural or man-made disasters. So these are the specified goods transported by GTA exempted. Second exemption, if the recipient is central government, state government or local authority registered only to deduct TDS, then also it will be exempted. Then if the recipient is individual, HUF or AJP, not registered and not having a factory, then it is exempted. In other cases, GTA will be taxable. Wherever GTA service is taxable, GTA is having 2 options. Option 1 FCM, option 2 RCM. In case of FCM option, again they have 2. Either they can pay GST at the rate of 12% with ITC. That is, if they want to take ITC, they need to pay 12%, and the recipient can take ITC of the 12%. If they don't want ITC, GTA don't want ITC, the rate of GST will be 5%, and that 5% recipient can take ITC. So the ITC non-availability is only to the GTA. This is FCM option. Whereas RCM option, recipient will pay GST at the rate of 5% and they can take ITC with respect to this. So previously GTA has to decide with respect to each invoice, but now it is with respect to each financial year. They need to decide it, either FCM option or RCM option. Accordingly, they need to choose. So if the question is silent, you go for RCM. Only if the question says that so GTA has opted to pay GST under FCM, then only it will be FCM. Otherwise, it will be RCM when the rate is given as 5%. When the rate is given as 12%, no doubt it will be FCM, because in case of 12%, we don't have RCM, so only it will be FCM. So that is that point. Then one more point you need to know is that whenever a motor vehicle is taken on hire by a company for the purpose of transportation of its employees, will it come under hiring of motor vehicles or a contract carriage? So here what they are telling is that if it is hired for a period of time during which the contract carriage is at the disposal of the service recipient, so therefore it is not for a particular trip. If it is for a particular trip, etc., then it will come under transportation. But here, whenever it is for like completely under the control of the company, then it will be treated like a contract carriage on hire. Contract carriage on hire will be taxable and it will not come under RCM. So only renting of motor vehicles will come under RCM, but contract carriage will not come under RCM. Then agriculture related services. For agriculture related services, we have only 5 exemptions. So first, any service in relation to agriculture or agricultural purpose or produce is exempted. So what is agriculture? Cultivation of plants, anything, any plant, or rearing of life forms of animals for food, fiber, fuel, raw material, or any other similar products. Agricultural produce means what? The primary produce out of agriculture on which no processing is done, or some processing as is usually done by a cultivator, which does not alter its essential characteristics. And so therefore rice is not an agricultural produce. And in case of rice, we have 4 activities which are exempted: loading, unloading, packing, storage, or warehousing. Then artificial insemination of livestock is exempted. Then many students ask me, sir, warehousing of fruits and vegetables, warehousing of sugarcane, etc. and all, is it taxable or exempted? See, if it is an agricultural produce, sugarcane, fruits and vegetables are agricultural produce, it is already covered under service in relation to agricultural produce, first point, and there itself it is exempted. If it is not an agricultural produce only, we need to think as it is it covered? Storage and warehousing of rice. Rice is not an agricultural produce, separately we have an exemption. Same way, storage or warehousing of cereals and pulses. Cereals and pulses is not agricultural produce, so but its storage is exempted. Same way, minor forest produce. Minor forest produce is not agricultural produce, but its warehousing will be exempted. So warehousing of fruits and vegetables is already covered under service in relation to agricultural produce. Then when it comes to healthcare services, so following are the healthcare services which are exempted. Only 2 healthcare services are exempted. Healthcare service by a clinical establishment, authorized medical practitioner or paramedics, including the ambulance service, is exempted. And healthcare service in relation to animals or birds. And we have renting of rooms. Renting of room is also part of healthcare services, but we have an exemption if it is ICU, like ICU charges, any ICU charges, so then it will be fully exempted, whatever may be the room rent. Suppose if it is any other room charges, so after operation or surgery, they will be kept in the room. So that room charges, if it does not exceed 5,000 rupees per day, then it is exempted. If it exceeds 5,000 rupees per day, entirely it will be taxable. So healthcare service definition you need to know: diagnosis, treatment and care. For what? Any disease, illness, injury, pregnancy in any recognized system of medicine in India. So any recognized system of medicine in India includes yoga also, and including transportation of a patient in ambulance. So whether transportation of patient in ambulance part of healthcare or not part of healthcare, separately also, but only transportation of patient in ambulance is exempted. And it does not include cosmetic surgery, plastic surgery and hair transplantation. But if these 3 are carried out to restore anatomy of body parts affected due to congenital defects by birth, developmental abnormalities during growth, or any injury or trauma, then it will be treated as healthcare service and it will become exempted. Then we have supply of food to the inpatients. So inpatients, anything given to them will be exempted. Medicine sold to inpatients, food supplied to inpatients, everything will be exempted. Whereas if it is to outpatients, visitors, etc., then it will become taxable. And service provided by consulting doctors to hospitals will also be coming under exempted. So a consulting doctor gets money from the hospital, that is exempted. Hospital getting money from the patient is also exempted. Then like IVF treatment is for curing the infertility. So due to that reason, it's a part of healthcare service and it will be treated as exempted. Then rehab professionals. So these rehab professionals will be working in certain medical establishments or educational institutions. So whatever money that they are getting for working as rehab professionals will be exempted. But if they are working in rehab centers, it should not be a private rehab center. It should be a rehab center owned by government or a trust, then only it is exempted. The next one, tour operator services. Services provided by a Indian tour operator to a foreign tourist in relation to the tour wholly conducted outside India will be exempted. What if the tour is partly in India, partly outside India? In that case also proportionately it will be exempted. What proportion it is exempted? So total consideration into number of days the tour conducted outside India divided by total number of days, or total consideration into 50%, whichever is lower will be taken as the exemption if tour is partly in India, partly outside India. Remember, tour operator is in India, and the tourist is outside India and the tour partly in India, partly outside India. And here, suppose while calculating the number of days, if it is greater than or equals to 12 hours, it should be considered as full day, and if it is less than 12 hours, it should be considered as half day for the purpose of this computation. Then next we have rule 42. So this rule 42 is in page number 63. So that is about manner of availment and utilization of credit. So first what you need to do is that in the question they will be giving lot of inward supplies. So all those inward supplies, first you need to check, are we paying the GST on that? So if you are paying GST on that, you put it under T. T refers to total ITC on inward supplies. And if you are not at all paying GST, like salary or some other not a supply, we are not paying GST, so don't take it. So first we are paying GST on inward supply, you put it under T. You take the total of this, and thereafter you need to take T1, T2, T3. T1 is inward supply used for non-business purpose, T2 inward supply used for exempted outward supply, and T3 block credit. While reading the question itself, you just mark T1, T2, T3 like that. So once you remove these three, the remaining is known as ITC availed in GSTR 3B. So whenever they ask a question, compute the ITC availed in GSTR 3B. So it is T minus T1, T2, T3, ITC availed in GSTR 3B. After this ITC availed in GSTR 3B, you need to take out T4. What is T4? Exclusively used for business purpose. Business purpose and taxable will be T4. Now whatever leftover will be known as common credit. Suppose if you know that 20% is used for non-business purpose and 80% is used for business purpose, then 20% you put under T1 and 80% you put under T4. So like that, if you know exactly how much is used for business, non-business, how much is used for exempted and taxable, if we got the ratio, so that we will divide in this place itself, so it will not travel into common credit. The moment it comes into common credit, then we need to do the reversal. So how we get the common credit? T minus T1, T2, T3, that will be called as C1, ITC availed in 3B. C1 minus T4, that is called as common credit C2. So this common credit, so we need to do reversal with respect to exempted. So C2 into E by F. So common credit into exempted turnover during the month divided by total turnover during the month. And D2, that is common credit attributable to non-business purpose, that is C2 into 5%. Now, say for example, we have some renting of immobile property, partly used for residence and partly used for business purpose. And we know exactly 1/3 is used for residential purpose, 2/3 is used for business purpose. Now 1/3 is residential, you put it under non-business. So 2/3 is used for business, in that both taxable and exempted is there, so it will come under common credit. But no need to do D2. Why no need to do D2? Because we segregated it in the beginning stage itself, so that's why we don't have to do it under D2. Now, so finally, how much is the net eligible ITC? When they use the word net eligible in MCQs, so if they use the word availed ITC, net eligible ITC. What is net eligible ITC? Total availed ITC minus D1 and D2. So that will be called as net eligible ITC for set off. And this computation, again, we need to do at the end of the financial year. So monthly we need to do, and again at the end of the financial year we need to do, and we need to compare it. If there is any excess reversal, so we can avail it as ITC, but that time limit for availment is 30th September of the next financial year. Usually the time limit for availment of ITC is 30th November of the succeeding financial year, or date of filing and return, whichever is earlier. But in this case, so D1 and D2 we have reversed excess, so which means more ITC we have reversed than the ITC to be reversed, which we are comparing at the end of the year. Now we can re-avail it as ITC by 30th September of the succeeding financial year. Suppose if there is any lesser reversal, D1, D2 what we have reversed is less than the D1, D2 computed at the end of the year. So that amount we need to pay along with interest at 18% per annum from the 1st April of the succeeding financial year till the date of payment of the difference. So that is about this. Then rule 43 talks about capital goods. So capital goods, we have capital goods used fully for taxable or business purpose, we can take the ITC, and capital goods fully used for exempted or non-business purpose, don't take ITC. If capital goods are partly used for business and partly used for non-business, partly for taxable, partly for exempted, first we will take the ITC and thereafter we will do the reversal. What we will do? So first you need to take the total common ITC. So there is one question, one student asked me, sir, there is one question in solve workbook wherein alpha, beta, gamma, like the 3 products are there, and they purchased the capital good used for beta and gamma only. So then we need to take the turnover of beta and gamma and we need to apportion, not like that. So total common credit we need to take. Common credit, maybe it is used for 2 machines or 3 machines or 4 machines. Total common credit we need to take divided by 60, because the life of the capital goods will be taken as 60, into exempted turnover of that month divided by total turnover of that month is the ITC to be be reversed with respect to capital goods. So this we need to follow the standard. Then next, suppose at the time of initial purchase we used it for CG1, that is used for taxable, and later on it became common. What is that we need to do? Nothing. So already we availed ITC. Now we will consider it as common ITC and we will do the monthly reversal E by F. Suppose initial purchase we used for exempted and later point of time used for common. Then in that case, at the time of initial purchase we have not availed ITC. So we will be availing ITC now. Now there are two reversal. Reversal for the past period. How much will be reversal for past period? 5% for every quarter or part thereof from the date of purchase till the date of conversion, and future reversal will be based on E by F. So total common credit divided by 60 into E by F. And in this place, that is in GST, everywhere they uses the word quarter. Quarter means calendar quarter. Calendar quarter means like even one day in that quarter we need to take it as full quarter. For example, so like 5th September to 2nd January. 5th September to 2nd January means September is one quarter, July, August, September. So that you count as one quarter, few days. Then October, November, December. January, few days. So you count as one quarter. So it will become 3 quarters. So don't take 3 months as one quarter in GST. GST everywhere it will be calendar quarter. In customs also everywhere it will be calendar quarter. Only in one place we'll take 3 months. We will count as one quarter, that is in duty drawback provisions. Otherwise, everywhere we will be taking as calendar quarter only. Even in that ICGR rules, so import of goods at concessional rate of duty rules, there we have depreciation. So in the depreciation also we have like 4% for every quarter or part thereof. There also will take quarter as the calendar quarter only. Then next, the special provision for banking company, financial institution, this also can be tested. So we have two options. Option 1, proportionate ITC as per rule 42-43, and option 2, avail 50% of the eligible ITC. But when we will take 50% of the eligible ITC, we should be careful. Like first we need to reduce the blocked credit and non-business purpose. Remaining used for taxable also treated as common, and used for exempted also treated as common. Out of the total ITC, 50% will be taken. Inward supply from a distinct person, 100% will be taken. And this option 1 excess cannot be withdrawn during remaining part of the financial year. Then section 50, interest computation, high time. So they might be asking a question on computation of interest on account of wrong availment and utilization of ITC. So there are 3 situations where the interest computation will come under section 50. Situation 1, I have filed 3B late. When I filed 3B late, simple, I have to pay interest from the first date after due date till the actual date of payment. So when I count from the due date, so don't count the due date, count the next date. Okay, from the due date means don't count the due date, count the next date, and date of payment also you need to include. Okay, and we need to compute interest on the net liability, not on the gross liability, because there is a delay in 3B. So interest from the first date after due date till the actual date of payment, computed on the amount paid to electronic cash ledger, that is net liability. How to arrive at the net liability? Simple. Gross GST under FCM minus input tax credit. First you need to take the gross liability on outward supplies under FCM. Thereafter we need to reduce input tax credit. Then you need to add GST on inward supply under RCM. Because for payment of RCM liability, we cannot use input tax credit. So gross GST payable under FCM minus input tax credit plus GST payable on inward supply under RCM, that will be taken as the net liability. So that net liability interest needs to be computed, and what is taken as the date of payment, actual date of filing 3B. Then situation 2, invoice not reported in GSTR1 and 3B for a particular month, but it is paid in another month. So through 3B, then 3B or any other mode. So means it is arrears of tax which we are paying. In that case, we may pay partly through credit ledger, partly through cash ledger, but interest will be computed on the gross liability. 18% from the first date after due date till the actual date of payment, compute on amount paid through cash ledger as well as credit ledger, that is on the gross liability. And what is considered as the date of payment, actual date of filing 3B, or if payment is made to 3RC3, that will be taken. Then situation 3, ITC wrongly availed and utilized. In case when ITC is wrongly availed and utilized, interest will be computed at the rate of 18% from the first date after utilization till the date of reversal. What is considered as the date of utilization? Date of utilization means, suppose if you have wrongly availed ITC 1 lakh, that month in which the balance in ITC falls below 1 lakh, to that extent we have utilized the ITC. For example, we availed ITC 1 lakh. In third month, the balance in ITC came down to 75,000, means 25,000 we utilized in the third month, and again it came down to 50,000 in the fourth month, then again 25,000 you utilized in the fourth month. Again the balance has increased. When the balance has increased, don't consider, leave it. Only when the balance has decreased, to that extent the ITC has been utilized. So we need to compute from the date of utilization till the date of reversal or payment, and compute on ITC utilized, that is the extent to which the balance in ITC falls below availed ITC. What is considered as the date of utilization? Actual date of filing 3B of that month or due date of filing 3B of that month, whichever is earlier will be taken, and date of reversal is the actual date of filing 3B. Then next, section 38. Section 38 says that even though supplier has filed GSTR 1, but in our GSTR 2B, so ITC will be coming under ITC not available. It will be restricted. Why? Because of few reasons. What are those reasons? If supplier is a newly registered business and supplier filed GSTR 1 but not 3B for some months, past months. For some past months, they have filed GSTR 1 but not 3B, or newly registered person, supplier liability in GSTR 1 greater than 3B for some months, and supplier has availed ITC in his 3B more than his 2B, or supplier has received the demand notices and he has defaulted in payment of taxes and defaulted in payment of 1% of liability through cash ledger as per Rule 86B. So in these cases, if you are making purchase from that supplier, even though supplier reports it in GSTR 1, it will come in under ITC 2B, under ITC not available. Then section 41 is also there. What does section 41 says? Section 41 is like supplier is there. Supplier reports the invoice in GSTR 1 and it is filed within the due date. Now, the moment supplier reports the invoice in GSTR 1 filed within the due date, the recipient can take the ITC. So, it will be reflected in 2B of the recipient and he can take the ITC. But supplier has not yet filed 3B. So, even then it will come under 2B under ITC available, yes. If the supplier has not filed 3B for more months, then only like future period, it will be restricted as per section 38. But for the current month, so it will come under 2B as ITC available and we can take that ITC in 3B. Recipient can take ITC in 3B. Now, supplier has not filed 3B within September 30th of the next financial year. So if he has not filed 3B by September 30th of the next financial year, then what recipient should do? Recipient should reverse the ITC by 30th November of the succeeding financial year. If he is not reversing by 30th November of the succeeding financial year, then interest will be applicable. So what is that interest? Interest will be at the rate of 18% as per section 50. So the moment we are referring to section 50, interest will be computed from the date of utilization till the date of reversal. Okay. And again, as and when the supplier filed GSTR 3B, the recipient can re-avail that as ITC without any time limit, but the interest paid, if any, cannot be availed as ITC. Then the next concept that we have is place of supply, IGST rules. So IGST rules is also quite a long time. They have not tested much about it. So they can be testing basis of apportionment. Mainly in IGST rules we have first the situation and the value needs to be apportioned on some basis. What is that? First to Rule 3. When Rule 3 will be applicable? Advertisement services provided to government or statutory body. And what is the base of apportionment of the consideration received? The place of supply will be, in case of advertisement service provided to government or statutory body, the place of supply will be each state where the advertisement is provided. And if we got the single consideration and we don't have the apportionment available in the contract, then we need to follow some basis as per Rule 3. Suppose if the advertisement is in train, we need to take the length of track in each state as the base of apportionment. Suppose if the advertisement is on the tickets, railway tickets, so then we need to see how many stations are there in each state. In that basis we need to apportion. Suppose if the advertisement is in television channel, then we need to divide the entire consideration between the channels based on viewership data published by BARC, Broadcast Audience Research Council, last week of the last quarter. And thereafter, again we need to apportion it between the states based on population census. And suppose if it is on internet, it is deemed to be across the country. So we need to take the internet subscribers data and we need to apportion. And if it is through SMS, we need to take the telecom subscribers data between the states and we need to apportion based on that. And we need to take TRAI, the Telephone Regulatory Authority of India, so data of the last quarter last week should be taken for apportionment. Apart from this, any other mode of advertisement on expenditure ratio, that is amount payable for advertisement ratio, in that ratio we need to apportion. Then rule 4 and rule 8, which talks about renting of immobile property. As per rule 4, in case of section 12, if both supplier and recipient are located in India, renting of immobile property, place of supply will be taken as the location of that immobile property. And what if immobile property is more than one state? Then rule 4 is applicable. Same way, in case of section 13, renting of immobile property, the service in relation to immobile property, we will be taking location of the immobile property. What if immobile property is in more than one state? So then rule 8 will be applicable. So whenever we have service in relation to immobile property, if immobile property location is taken as place of supply, and if that immobile property is in more than one state, suppose if it is accommodation services, then we need to take the apportionment as number of nights stayed in such property in each state. And suppose if it is accommodation, a house, boat or vessel, time spent by that boat or vessel in each state. Any other service in relation to immobile property, we need to apportion it based on the area of the immobile property in each state. Then rule 5 and 9 talks about service in relation to organizing an event, and if the event is held in more than one state, we need to apportion on the basis of GAAP, that is expenditure ratio. Then computation of value of service, rule 6, in case of telecommunication services by way of fixed line services, say if it is a lease line, so if it is installed in connecting more than one state, the number of circuit points in each state, that should be taken as the base of apportionment. And in case of performance based service in relation to goods or individual, as per section 13, suppose if it is same goods, then we need to divide it in equal ratio. If it is different goods, we need to take the invoice value and we need to apportion. Suppose if it is performance based service in relation to individuals and location where service actually performed is in more than one state, so using the GAAP, that is generally accepted accounting principles expenditure ratio, we need to take it for apportionment. Then the next concept is section 29, cancellation of registration. So page number 107. So there are total 8 situations that leads to cancellation of registration. Those 8 situations you need to remember. Number 1. So first 3 cases where application can be made by the registered person for cancellation of registration, or suo motu proper officer can initiate cancellation of registration. That is transfer or discontinuance of business, change in constitution resulting in change in permanent account number, and the person no longer liable to be registered. Thereafter, and in this case, whenever the application is made by the registered person for cancellation of registration, other authentication is mandatory. And suo motu cancellation by the proper officer in 5 cases. Number 1, contravention of certain provisions of the act or rules, and then returns not filed by a composition scheme dealer within 3 months, annual return not filed within 3 months after due date. The due date is April 30th of the next financial year. From there, within 3 months, if they have not filed annual return, so then next normal person not filed 6 consecutive monthly returns or 2 quarters consecutive returns if they have not filed. Then registration obtained by fraud, and they have obtained voluntary registration but not commenced business within 6 months. So in these cases, even now TDS TCS deductor also can make application for cancellation of registration. Then what is the meaning of contravention of the provisions of act or rule? So total 7 points we have in that. That is, does like wrong address. Wrong address means they are not doing business in the place where they have obtained registration. Wrong invoice, they have given invoice in contravention of the provisions of issuance of invoice. Then wrong ITC, so they have availed ITC in contravention of provisions of section 16. Then 3 wrong. Then 3 violation of anti-profiteering provisions, and violation of furnishing the bank details within the specified time, and violation of rule 86B, that is not paying 1% of the gross liability through electronic cash ledger. Then next 7th point is, if their liability in GSTR1 is greater than 3B for 1 or more tax periods, if they have availed ITC in 3B more than their 2B for 1 or more tax periods. So these are the 7 cases which leads to contravention of provisions. That is one of the case for cancellation of registration. Then section 132, imprisonment provisions. What are the cases where imprisonment will be applicable? So you can refer this in page number 136 of that set book. So bio discredits TFT minus ISRD STT. So what is this? Bio discredits FTT. So this is actually list of offences that leads to penalties. B for books of accounts default, I for invoice default, O for obstructing an officer from doing duty, D for dealing in goods liable for confiscation, another I is for ITC default, and yes is for supply with the GST of another person. C, collected tax not paid within 3 months, or collected amount as tax not paid within 3 months, and R for registration default, and E for erroneous refund, and D for disposal of goods while detention or seizure is operational, and I for ISD default, T for transportation related default, S for suppression of turnover, another T is tampering material evidence, F for failure to supply information or supplying false information, and last T is tedious TCS default. So these are the offenses that leads to penalties. Now take those offenses minus ISRD STT. I refers to ISD default. So only invoice default and ITC default is offense for imprisonment. Then yes, both yes, supply with GST of another person or suppression of turnover or registration related default, and D, that is disposal while detention or seizure is operational, and 2 T's, that is tedious TCS and transportation related default. But tampering material evidence is a offense for imprisonment. Even C, collected tax not paid within 3 months also not an offense. Only collected amount as tax not paid within 3 months is an offense for imprisonment. Okay, plus attempt to commit or abetting commission of these offenses. So these are the offenses for imprisonment. Now once these offenses are covered under imprisonment, what is the imprisonment? Is it first time offense, like first time or subsequent? If it is first time, books of accounts default, obstructing an officer from doing duty or tampering material evidence, BOT, then in that case up to 6 months or fine or both. And if it is other offenses, greater than 1 crore up to 1 year, greater than 2 crores up to 3 years, greater than 5 crores up to 5 years plus fine, and there is a minimum imprisonment of 6 months. If it is subsequent, all these cases, subsequent offense will be minimum 6 months and up to 5 years plus fine. And what are considered as non-bailable offenses? There are 3 offenses which are non-bailable offenses: cognizable and non-bailable. Invoice default, ITC default, collected amount as tax and not paid within 3 months will be coming under non-cognizable offenses. Non-cognizable or cognizable? Cognizable plus non-bailable offenses. Invoice default, ITC default, collected amount as tax not paid within 3 months, that too amount exceeds 5 crores. Amount exceeds 5 crores, then it will be called as cognizable and non-bailable. Then when arrest will be applicable? Same. These 3 offenses, when the amount exceeds 2 crores, arrest will be applicable. So these 3 offenses, when the amount exceeds 2 crores, arrest will be applicable. So therefore, when it exceeds 2 crores or 5 crores, arrest will be there. But if it exceeds 2 crore but does not exceed 5 crore, it will be called as non-cognizable and bailable. When it exceeds 5 crores, it will be called as cognizable plus non-bailable. All other offenses, arrest cannot be made, and for namesake it can be called as non-cognizable plus bailable offenses. Then revisional authority under GST section 108. So refer page number 129. We have this concept again. So lot of attempts they have not tested this. They can ask. Revisional authority is appointed for revision of adjudication order. Already once the adjudication order is passed by the officer, so thereafter either the registered person, that is a person to whom the order is served, can go for appeal, or the department can go for appeal. If no one is going for appeal, the revisional authority will take up the order for revision, and revisional authority may on its own motion or upon information received by it or on request from the commissioner, they will call for and examine the records of the proceedings, and if it is considering that the decision is erroneous or prejudicial to the interest of revenue and is illegal or improper, then they may stay such order, and after making further inquiry, either they can enhance or modify or annul the said decision or order. And no revision in certain cases. That can be asked as a short note question. Number 1, if an order is subject to an appeal, however in that order on few grounds we did not go for appeal, so then with respect to those few grounds the revisional authority can revise the order, and order has already been taken up for revision but they have not revised anything, or order taken for revision and they have passed the revisional order, again that cannot be taken for revision. Then time limit for revision order. So suppose if appeal is filed, if appeal is filed we cannot do revision. No, we can do revision with respect to the few grounds on which appeal is not made. So in that case we need to take 3 years from the date of adjudication order or 1 year from the date of appeal order, whichever is later. Suppose if the appeal is not filed, then in that case, so 3 years from the date of adjudication order, and the revision authority will invoke after 6 months. So their jurisdiction will come after 6 months from adjudication order and within 3 years from the adjudication order. And while computing this period of 3 years, if there is any stay that is granted, that should be excluded, or if the similar proceeding is somewhere in a high court or supreme court, that period should also be excluded. Then next, non-applicability of EV bill. So page number 153 you see. So when EV bill is not required, so this is very important. So in case of transportation of non-motorized vehicle, EV bill is not required, and in case of goods transported between the customs places like inland container depot, container freight station, port, airport, customs warehouse, etc. Even then EV bill is not required. Then transit cargo transported to or from Nepal or Bhutan. Then movement of goods belonging to Ministry of Defence and empty cargo containers are being transported. Then so taking the lorry to a weight bridge up to 20 kilometers within the state. If it is interstate weight bridge, definitely EV bill is required. All these are intrastate. This is intrastate. Intrastate weight bridge up to 20 kilometers accompanied by a delivery challan. And goods transported by rail where the goods belongs to central government, state government or local authority, and goods specified as specifically exempt from EV bill provisions by the respective states. And there are some transportation of specified goods like LPG for non-domestic or exempted category customers, then other than dealers of cylinders, then kerosene oil sold under PDS, postal baggage, then jewelry other than artificial jewelry, that is imitation jewelry is there that requires EV bill, other jewelry, precious stones, semi-precious stones, natural culture pearls, etc. Then used personal or household effects also do not require EV bill. So maybe in MCQ or in a question they may be testing it. Then we have some circulars here related to demand and recovery. So demand and recovery, there are three clarifications that has been provided. So which gives the difference between 122 subsection 1 and 122 subsection 2. 122 subsection 1 says there are some offences, that is biodiscredits TFT. In case of these offences, biodiscredits TFT, so the penalty will be 100% of tax or 10,000, whichever is higher. Whereas 122 subsection 2 penalty is in 5 cases: non-payment of tax, short payment of tax, wrong availment of ITC, wrong utilization of ITC and erroneous refund. These 5 cases penalty will be under 122 subsection 2. So whenever 122 subsection 1 comes into the picture, 122 subsection 2 should not be applicable. So for that only they have given 3 clarifications. For example, Mr. Amar is a supplier who is not making supply of goods or services but just issues the invoice to Mr. Balaji, a recipient. Now in that case, as there is no supply, liability, actual liability is not there, but it is an offense called as invoice default. So as it is an invoice default, penalty will be levied on Mr. Amar. Demand and recovery under 7374 cannot be initiated. Remember, only when there is demand and recovery 7374, the penalty under 122 subsection 2 will come. As there is no liability on Amar, demand and recovery will not come. So on Amar, there will be penalty under 122 subsection 1, that is invoice default. Then another case, Mr. Amar is making supply of goods or services to Mr. Balaji, not making supply of goods or services, but just raises the invoice. Now what Balaji did, he availed the ITC and adjusted against his liability. Then in that case, whether on Balaji demand and recovery can be initiated under 7374, yes, because he availed the ITC and adjusted against the liability means there is a short payment of tax. Because there is a short payment of tax, demand and recovery under 7374 can be initiated. Then penalty will be under 122 subsection 2. So therefore, on Mr. Balaji, penalty under 122 subsection 1 will not be applicable. So will not be initiated because 7374 is initiated. Then another clarification, Mr. Amar is giving invoice without supply to Balaji. Balaji availed the ITC. Again, Balaji is raising invoice without supply to Charan. Now, whatever ITC availed by Balaji adjusted with the liability, artificial liability or like duplicate liability that is created. Now, in this case, on Amar, there is no liability actually. Actual liability is not there. So therefore, there will be penalty under 122 subsection 1, invoice default. On Mr. Balaji also, there is no actual liability. Just he took the ITC and he gave the invoice without supply of goods. So 2 offences. First, ITC default. He availed the ITC. So on that penalty under 122 subsection 1. Again, invoice default. So 2 times he need to pay penalty under 122 subsection 1, invoice default and ITC default. And thereafter, Mr. Charan has availed the ITC and adjusted against his liability, which means because of this, there is a short payment of tax. So on Charan, there will be demand and recovery under 7374. The penalty will be under 122 subsection 2. So 122 subsection 1 penalty will not be applicable. That is about these 3 circulars. Then one more important point is that usually whenever stay is granted by the court or GST 80 for notice or order, such period shall be excluded from the notice or order due date. And notice issued under section 74 not sustainable in the court, the same shall be converted to 73 notice. So when 74 will come into the picture, these 5 cases: non-payment of tax, short payment of tax, wrong availment of ITC, wrong utilization of ITC or erroneous refund. If it is on account of fraud, collusion, willful misstatement, suppression of facts, or contravention with an intent to evade payment of tax, then the penalty will be levied under section 74. Suppose if it is other than fraud, then the offense will be covered under 73, demand and recovery under 73. First, department initiated 74, but we went for appeal and stated that there is no fraud. The court is also agreeing that there is no fraud. Now, the same 74 notice should be trimmed to 73 notice when the matter is remanded back for fresh adjudication. So, what appellate authority will do? Appellate authority will say, okay, this is not on account of fraud, so they will remand the matter back for fresh adjudication. Then in that case, demand order should be passed within 2 years from the date of communication of direction. Usually demand order should be passed within a prescribed time limit. So 3 years or 5 years. In case of 73, 3 years from the due date of furnishing and return. In case of 74, 5 years from the due date of furnishing and return. This is the time limit for passing demand order. But in this case, the matter is remanded back for fresh adjudication. So 2 years from the date of communication of directions. And here, say this, notice is issued under 74 but not sustainable in the court. Now, is that notice given within 2 years, 9 months? Because what is the time limit for 73? 3 years minus 3 months means 2 years, 9 months from the due date of filing and return or date of erroneous refund. That is time limit for notice under 73. Yes. Then in that case, whatever is the amount that is there, that can be recovered because the notice is given within the time limit. Suppose if the notice is given beyond 2 years and 9 months from the due date of annual return or date of erroneous refund, means beyond the time limit for notice under 73, entire proceeding shall be dropped because the notice is not given within the time limit. Suppose if the notice is given under section 74 for multiple financial years and such demand order is not sustainable in the court of law, then in that case, suppose if the 74 notice is given for 5 years, but as per 73 we can recover only for 3 years, means the 3-year liability only will be recovered. That is this. Then next we have section 9 subsection 4, purchases from an unregistered person. So there is a promoter or builder who is making purchase from an unregistered person on which the promoter or builder is required to pay GST under RCM. You need to remember 3 steps. Step number 1, capital goods. Capital goods purchased from registered person, no need to pay GST under RCM 94. Capital goods purchased from unregistered person, GST payable under RCM 94 at the rate applicable to capital goods. Then second point, cement. Cement purchased from registered person, leave it. Cement purchased from, like, no need to pay GST under RCM. Cement purchased from unregistered person, GST payable under RCM at the rate of 28%. Then other goods and services purchased from unregistered person divided by total inputs and input services. While taking total inputs and input services, we should exclude electricity, high-speed diesel, motor spirit, natural gas, TDR, FSA, long-term lease. These 5 things we should exclude. And purchases from unregistered person divided by total purchase of inputs and input services into 100. You see that percentage. If the percentage is less than or equals to 20%, okay. Because up to 80% we can buy from registered and remaining 20 we can buy from unregistered person. So no need to pay GST under RCM. Suppose if it is more than 20%, suppose if it is 25%, then on excess 5% we need to pay GST under RCM at what rate? At the rate of 18%. So then section 9 subsection 5, so liability to pay GST on e-commerce operator. There are 4 services which are covered under 9.5 where liability is on e-commerce operator, that is HATE. H for housekeeping services, A for accommodation services. In case of housekeeping and accommodation services, supplier should be unregistered, then only it will come under 9.5. And in case of T and E, transportation of passengers by any motor vehicle and eating food from a restaurant, whether the supplier is registered or unregistered, it will come under 9.5. Here one important point is there, if there is a restaurant which is in a hotel where the hotel declared tariff is greater than 7,500 rupees per day, in that restaurant if it is supplying food through e-commerce operator, restaurant only will pay, it is not covered under 9.5. Otherwise restaurant service will come under 9.5. Whenever e-commerce operator is liable to pay GST on above services or e-commerce operator is liable to deduct TCS, they are compulsorily required to get registered. And so then, and on one more point is that whenever e-commerce operator is paying GST, TCS will not be applicable. So section 9.5 and 52 are mutually exclusive. Only in case of notified services, e-commerce operator will pay GST. In case of other transactions, Supplier only will pay GST, e-commerce operator will not pay. Then what is the liability on e-commerce operator? Only the commission. Every e-commerce operator who is liable to pay GST or liable to deduct TCS is compulsorily required to get registered. Also, every supplier of goods through e-commerce operator is compulsorily required to get registered under GST irrespective of aggregate turnover. Then supplier of notified services or supplier of other than notified services is required to get registered only when their aggregate turnover exceeds threshold limit for registration. Then we have rule 86B. This 86B is in page number 113, which says that whenever our monthly turnover exceeds 50 lakhs, while computing the monthly turnover, don't take exempted turnover, don't take zero rated supplies, don't take non-taxable supplies. So purely taxable turnover. If it exceeds 50 lakhs in a month, then 86B will be applicable. What is it they need to do? Whatever is their gross liability on outward supplies, of that gross liability, 1% they have to pay through cash ledger and 99% they can use from the credit ledger. Even though they have sufficient balance in credit ledger, they can use only 99% of their gross liability from credit ledger and they have to pay 1% from the cash ledger. And these provisions are not applicable to government department, PSU, local authority or statutory body, or if they have paid such person or proprietor or karta or managing director or any of its two partners deposited income tax of greater than 1 lakh in each of the 2 years, or received a refund of unutilized ATC greater than 1 lakh in the preceding financial year, or paid greater than 1% cumulatively up to the current month in the current financial year, then also they are not required to comply with 86B. Then special points with respect to electronic cash ledger. What are the various modes of deposit into the electronic cash ledger? So we have multiple modes now: internet banking, debit card, credit card, NEFT, RTGS, cash deposit over the counter up to 10,000 rupees, and UPI and IMPS. These are the multiple modes. And then we have one point, that is we can transfer the balances in the electronic cash ledger from one cell to another cell. Not only that, from one distinct person to another distinct person also we can transfer the balance in electronic cash ledger. To do this transfer of balance in the electronic cash ledger, they need to use PMT9. But one condition is there. However, transferor should not have any liability in the electronic liability ledger. Means first they need to use the cash ledger balance for payment of transferor's liability. If there is any excess balance, that can be transferred to the distinct person to in another state or in the same state another registered person of the same permanent account number. Then section 89, liability of directors of a private company. Suppose if the company is a private company, all directors are jointly and severally liable. And suppose if the private limited company becomes public limited company, then those directors are not liable even before the date when the liability pertains to, before the date of conversion. The moment private limited company becomes public limited company, before the date of conversion some liability is there, even that liability directors are not required to be paid. That is this point. However, if private company is converted into public company, then directors shall not be liable. Then liability in case of partners of a firm. So partners and firm are jointly and severally liable for the dues, and retiring partner will continue to pay the dues till the date of his retirement if he has given the notice of his retirement within 1 month from the date of his retirement to the commissioner. Suppose if he has not given the notice of his retirement within 1 month from the date of his retirement, then till the date he gives the notice of retirement to the commissioner, he will be liable to pay the dues even though that is after his retirement. Then in customs, mainly we have to learn these differences between protective duty, safeguard duty, anti-dumping duty and anti-subsidy duty. So this anti-subsidy duty is also called as countervailing duty under section 9, and sometimes it will be called as anti-subsidy duty also. So here, so who will be levying protective duty? Protective duty will be levied by central government on the recommendations of tariff commission, but the safeguard duty, anti-subsidy duty and anti-dumping duty is levied by central government upon receipt of complaint or information. What is the relief? So protective duty is to give the relief against the imports that causes serious damage to the domestic industry. In case of safeguard duty, when the goods are imported in large quantities, and anti-subsidy duty, whenever the imported goods enjoy some subsidy in the pricing by the government of that country. Then anti-dumping duty, when goods are imported at a cheaper price into India. What is the extent of relief? Protective duty is simple increase in the basic customs duty. So we don't have to do anything, just the basic customs duty increase, that is sufficient. But safeguard duty will be like a percentage. It will be given as a percentage, and that percentage will be applied on the assessable value or landed value. What will be landed value? Assessable value plus basic customs duty plus social welfare surcharge. And suppose if the question is silent, you compute it on the assessable value. If the question says assessable value or landed value, accordingly you take. So then even anti-subsidy duty is also like that only. Rate will be specified in the question. Whereas anti-dumping duty is lower of dumping margin or injury margin. So what is dumping margin? So sale price in their country minus the price at which they have exported to India. Injury margin means normal selling price in India minus landed value of the imported goods. Landed value means assessable value plus basic customs duty and social welfare surcharge. Then investigation is not required in case of protective duty, but investigation is required in case of other three. And until the completion of that investigation, a provisional duty can be levied. Safeguard duty provisional for 200 days, anti-subsidy duty 4 months, and anti-dumping duty will be for 6 months. And whenever finalization happens, either we will get the refund if we have paid excess in provisional, or we will have to pay differential duty. What is the duration of levy? Safeguard duty will be levied for a period of 4 years, and it can be extended for a further period of 6 years, so maximum 10 years. But anti-dumping duty and anti-subsidy duty 5 years plus 5 years, so unlimited time. Every 5 years they can review and they can continue. And exemption, these three additional duties, that is safeguard duty, anti-dumping duty and anti-safeguard duty, that is anti-subsidy duty, these three will not be levied on imports by 100% TOU or SEZ. But if they are importing it and selling it to SEZ, then selling it in DTA, then it will be applicable. Retrospective levy, safeguard duty cannot be levied retrospectively, but the last two can be levied retrospectively up to 90 days prior to the date of notification. Retrospectively they can levy it. And this review they need to do for every 5 years in order to extend the applicability of anti-safeguard, like anti-dumping duty and anti-subsidy duty. But within 5 years, if they have not decided, there is an automatic extension of 1 year if not decided whether to extend or not within the period of 5 years. And then section 20, reimportation of goods. So notification 45/2017, what does it say? First, a person is importing the goods. When they are importing the goods, they need to pay the customs duty. Whenever these goods are exported, after export of these goods, so if any incentive is claimed at the time of export, upon reimport of this, whatever incentive we claimed at the time of export, we need to pay that. Suppose if it is exported for repairs, then on reimport, customs duty payable will be fair cost of repairs, including material and labor, freight and insurance, both ways. What is the time limit from export to reimport? The time limit is 3 years plus 2 years. Okay. Then next, see, I am like just taking the session and I will see your doubts later on. So let me complete this and see whatever doubts that you have, and based on that I will reply to your queries. Okay. So just hold on. Then that is about this notification 45/2017, and from the export to the reimport, the time limit is 3 years plus 2 years. And abatement under section 22 concept also you need to learn. So abatement mainly the computation. So when abatement is applicable, whenever the imported goods are damaged or deteriorated, and how much will be the abatement? Proportionate to the value of damaged goods, we will be getting the abatement. Whether abatement is applicable in case of warehoused goods, if it is damage, yes. If it is deterioration, only before at the time of unloading, if there is deterioration, we will be getting this, that is this. Then duty drawback under 74 versus refund under section 26A. So just go through that once. So because duty drawback under 74 and refund 26A is one area which they have not yet connected, so that is a possible. So this is there in page number 196. You can see this table. Okay. And thereafter we have import of goods, set of articles. So whenever we are importing some set of articles, what we need to do, if all the goods are chargeable to duty at the same rate, so you take the same. Suppose if it is chargeable to different rates, so then we will be taking the highest rate. Suppose if separate value is ascertainable, we will take separate rate. If it is compulsorily, accessories compulsorily supplied, we will take the accessories also at the rate applicable to main article, otherwise we will take the highest rate. Then this deductive value and computed value, sums are there, you check that sums once. And then deferred payment of customs duty. So deferred payment, whenever we are required to pay the customs duty, we have two options: immediate payment option and deferred payment option. Immediate payment option means whenever the bill of entry is approved, immediately we need to pay, otherwise interest is payable at the rate of 15%. Remember, in customs the rate of interest is 15% per annum. And in case of deferred payment, if the bill is approved from 1st to 15th of the month, 16th working day of the month is the due date. and in case the bill is returned or approved from 16th to 30th or 31st of the month, the next month first working day will be taken. If it is month of March, 31st March. By this due date, if you are not paying, then only interest will be applicable at 15% per annum. Then payment of customs duty through electronic cash ledger and electronic duty credit ledger. So here we have the concept of cash ledger and duty credit ledger in customs also, section 51A and 51B. So any amount that is deposited into the electronic cash ledger will be credited to this ledger, and the balance in this ledger can be used for payment of customs duty, interest or penalty. Unutilized balance we can get as a refund. But the balance in duty credit ledger, when it will come, whenever we are getting any refund upon export or incentives under foreign trade policy, that will come into duty credit ledger. Balance in this ledger can be used only for payment of customs duty, that too basic customs duty only. Unutilized balance cannot be claimed as refund. In this case, we have cash ledger regulations. Cash ledger regulations, any deposit made in the cash ledger shall not accrue any interest, and the deposit challan is valid for a period of 15 days. What are the modes of deposit? We have only net banking, NEFT, RTGS, over the counter up to 10,000 in a day. This over the counter 10,000 in a day is not applicable. Limit is not applicable, means they can deposit any amount in case of government department or any authorization given by the customs officer, that person. Then commission or charges payable for deposit shall be borne by the person who is making the deposit. Upon successful payment, a challan identification number shall be generated, and whatever money that is in the ledger can be used for payment of duty, interest, penalty, fee and others, and any balance left we can claim as refund. So this is about electronic cash ledger regulations. But this electronic cash ledger regulations is not applicable, so which means normally only they will make the payment in case where the customs automated system is not in place, or accompanied baggage, or making payment other than under Customs Act or Customs Tariff Act, that is demurrage charges, custodian charges, etc. Then next, electronic duty credit ledger regulations. What does it say? The moment we are submitting the shipping bill, we are eligible for an incentive. So whenever we are eligible for an incentive under export or FTP, so we will get that incentive as a script, e-script in the electronic duty credit ledger. That e-script can be used only for payment of basic customs duty on import of goods, or we can transfer the e-script to any other person. And this e-script is having a validity. So within the time limit only, the e-script should be utilized. So the e-script shall be valid for a period of 2 years from the date of its creation, and by that time the e-script should be utilized. Otherwise, the balance will be lost. And we can transfer the e-script fully only, part e-script cannot be transferred, okay, and we can use it only for payment of basic customs duty. This many points, if you remember, that is sufficient. Then warehousing interest. So whenever goods are deposited in the warehouse, so what is the period for which it can be deposited? It can be deposited for a period of 1 year, and it can be extended for a further period, and considering the nature of goods, it can be reduced for less than 1 year. But this period is not applicable in case of EOU, EHTP, STP or warehouse where manufacturing operations are permitted. And so only, even though we have 1 year as the time limit, but if the warehousing period exceeds 90 days, interest will be payable. So interest is payable at 15% per annum from 91st day after the date of warehousing order till the date of actual clearance and payment of customs duty. Then as per section 65 and 66, so manufacturing and other operations are permitted in the warehouse. So, and duty not payable on such warehoused goods if the processed goods are exported. So we imported some goods in the warehouse, we processed it and we exported, no need to pay duty on the imported goods. However, customs duty payable on the waste and scrap. So in that process, there is some waste and scrap that is cleared in DTA. So on that waste and scrap, customs duty payable at the rate applicable to waste and scrap, but not the rate applicable to the imported goods. If such waste and scrap is destroyed in the warehouse, no need to pay customs duty on that waste and scrap. Then late fee for delay in filing bill of entry. So we have the late fee as if the delay is up to 3 days, then the late fee is 5,000 rupees per day. If the delay is beyond 3 days, then it will be 10,000 rupees per day. And what is the maximum late fee? If it is exempted goods, subject to maximum 50,000. If it is dutiable goods, subject to maximum 100% of duty payable. What is the time limit for filing the bill of entry? Before the date of arrival, it should be filed. Even prior bill of entry also can be filed, but the prior bill of entry validity will be within 30 days prior only they can file. Suppose within 30 days, the vessel did not arrive or the aircraft did not arrive, again they need to file a fresh bill of entry and they need to end up paying the late fee. So these are some hardcore important concepts which are there in GST and customs which you need to revise. Okay, so already I gave you a brief revision related to this, and so let's answer whatever queries that you are having. So please share penalty summary if you have. So please refer to the Rocket Revision Offense and Penalties chapter, so where you can see a quick revision of penalties, and this PDF is from the That's It book only. I have just taken from That's It book. If you are having That's It book, you can see. Would just watching revision lectures would be enough as given in strategy for tomorrow exam? Yes, revision lectures are enough. You don't have to do anything. That's It book plus revision lectures plus Mighty 50. That will be sufficient. More than that is not required. So then, how to attempt the paper? Yes, I will discuss that. So RTP November 23, already I incorporated those questions in Mighty 50 itself. So therefore, no need to do that RTP 23. So yes, GD link for important concepts. Okay, what is the name of the file? Telegram, PDF. What is the strategy to write the exam for utilizing? Yes, I will explain that. Yes, see, remember what we need to do is that the strategy is simple. First, you have actually like 3 hours time. You divided that 3 hours into 30 minutes each. Okay, you divide that 3 hours into 30 minutes each. So total 3 hours you have now. So it will be into 30 minutes part. 30 minutes each part. Okay, so 30 minutes of 5 parts, 6 parts you divide. Okay, and in the first 30 minutes, so you divided your 3 hours into 6 parts. So in this, you have 15 minutes gap, 15 minutes before. In that 15 minutes, you try to read the question paper, not read fully, but read the requirement. So you see every question, what is the requirement? So read the requirement in the question. So when you read the requirement in question, you will know which question to attempt, which not to attempt. That you decide in the 15 minutes. Then, so usually 6 parts we have. So first MCQ and descriptive, it will take hell lot of time. So my advice is put it at the end. Put it at the end. So therefore, this last 1 hour you use for MCQ and first question. First question you use, last like MCQ and first question, and you try to attempt the 4 questions in the first 2 hours. Definitely will save time, because these questions will be simple and easy. You will be able to complete it in 1 hour 45 minutes. Even though you allocated 2 hours, you can complete it in 1 hour 45 minutes. Because what I heard from many students is that they are taking more time in MCQ and the first question. That's why I asked you put in the last. Now you will save some 15 minutes time that you can use it for MCQ and the first question. Okay, so that you attempted everything. Now with peace, you can answer MCQs and you can answer the first question, so that you will not have any trouble. Otherwise, what will happen? MCQ plus first question itself, it will take 1.5 hours, and thereafter remaining 1.5 hours you need to write all the other questions. You will make mistakes also. So this is actually a scoring area. This question number 2 to question number 6 is the scoring area, because there we have a parts of 4 marks, 5 marks questions. So in that 4 marks, 5 marks question, 3 marks, 2 marks and all, if you are getting now, that's a big scoring area, and it will be easy also. To the point only they will be asking. So you try to attempt this 2 to 6. In this 2 to 6, any 4 you need to write, so that you complete it. And 6th question you see once. 6th question is usually a theory question. You see once the 6th question. If it is like, if the theory is easy for you to attempt, please attempt the theory question only. Reason being, theory it will not take much time for you to write. So therefore you can attempt that, and you can skip one practical question which is like big time. It will be time consuming, that you can skip. Okay, but of course it is up to you. You can decide, but you can ensure that you can complete it in 1.45 minutes, so that you are at ease. Now this MCQ and first question marks is what? 30 marks and 14 marks. Happily, with cool mind, you can sit and complete it. So follow this strategy. Okay, so that you will be definitely saving the time, and see the requirement properly in each and every question. Okay, then first question, what you need to do. So whenever you are writing the first question, the case study type question, 14 marks question, prepare like you take 4 pages. You take 4 pages. So page 1, page 2, page 3, page 4, like that 4 pages you take. In page 1, you write, so statement showing outward supplies under FCM. Outward supplies under FCM. That is statement 1. Then page 2, you take statement showing inward supplies under RCM. Inward under RCM. And again in page 3, you take input tax credit. Input tax credit. In page 4, net GST liability. Net GST liability. So what is that net GST payable? Net GST payable is simple. So statement 1 minus statement 3 plus statement 2 will be taken as the net GST payable. In page 1, when you are taking outward under FCM, you divide it like, so particulars, then CGST, SGST, IGST, like that you divide and you write parallelly. Note and all you write in the particulars itself. You try to write in the particulars itself note, or don't worry if there are more number of transactions, so you don't write the note. Last, after completion of this, we can make notes of that. Okay, so you make this like this. So whenever you have outward supply, the moment you read the transaction, you know that it is outward supply. Put it in statement 1 and write outward supply under FCM. Outward supply under RCM, you should not put it in the liability at all, because it's not your liability. Outward supply under RCM is that person's liability, don't add to your liability. Okay, outward supply under FCM alone, we need to put it here. Then whenever we have some inward supply under RCM, remember there are 2 adjustments. It will come in statement 2 as well as in statement 3. ITC also it will come. So parallelly we need to write in both places, inward supply under RCM and ITC. And like this, each and every transaction you read and you update it in the respective tables, so that finally you will be able to arrive at the net GST payable. So keep this in mind. Okay, then so MCQs and case scenarios, yes, and there are few case scenarios which I thought as important, because I heard from one student like, sir, there are many case scenarios which were repeated from the ICA booklet for audit exam, DT exam and all. So I have marked 5 important case scenarios. So please solve that and go. 5 important case scenarios. 5 important case scenarios. So I'm just giving the page number reference, like a case scenario number reference. So first, as per solutions, like that, one case scenario is there. This is there in ICA booklet case scenario number 3, and in our book, suppose if you have our book, MCQ book, in our book it is, so case scenario number 1. Then second one, supernova, like that one case scenario is there. That is case scenario number 5 if you have ICA booklet, and if you have our book, then it is 2. Then next, doodle incorporation, like that one question is there. ICA it is 7, and in our book it is 3. And then Suraksha travels, like that one case scenario is there. So in ICI booklet it is 24, in our book it is 16. And SR associates, like that one case scenario is there. That is number 1 of ICI, and in our book it is 33. Okay, these are the 5 important case scenarios. You please take time today and revise it and go. So because out of all the case scenarios which I have seen, these are really little tricky and important. So please go through that. If you have any doubts, you just ask me in the Telegram. I will reply to that. Okay. Next, sir, the format for solving ITC question. That's what I have given. So this, you do that. Then step marking, yes, there will be definitely step marking for each and every question. Then even total value is considered 1 column. That is depends. Value, if you want, you can take it. Otherwise, not required. You can do it. Can you share the PDF of this important? So it is already there in That's It book pa. Already I shared like what are the important concepts. You can see this. Then in which book these case scenarios are available? ICA booklet. ICA MCQ booklet is there. In that ICA MCQ booklet it is there. Suppose if you have purchased our Inquest book, already some students have purchased, for that them only I gave you this. Yes, these case scenarios are really sufficient. Okay. Then easy format for T1, T2, T3, whatever I have explained itself is a easy format pa. Just remember, first we need to take T, all GST paid on inward supply, minus T1. So T1 is non-business purpose, minus T2 exempted supply, minus T3 blocked credit. The balance you get is C1, that is ITC availed in GSTR 3B, and thereafter T4 inward supply used for taxable and exempted. Then you will be getting C2, that is common credit attributable to exempted, that is C2 into E by F, and D2, that is common credit attributable to non-business purpose. So just this format you remember. Okay. Next. So now we will see in FTP, so some important concepts for quick revision purpose. So you can see the FTP notes already I have shared in my website. So it is there, and see, many students were asking me, sir, time limits, monitor limits. See, these are the files which I have already shared. If you see here, CA final time limits updated for November 23 exam. This is the time limits. Summary of all time limits is there. Quickly you can revise that once. Then monitor limits also is there. Then interest computation under GST summary, and then computation under customs. Then amendments file also have given, and foreign trade policy. In this foreign trade policy, there are like many students ask me what are the important areas to be referred. So I'm just giving the important areas so you can refer to those areas. Basically in this you need to know first foreign trade policy. The current foreign trade policy is with effect from 1/4/2023, and usually for every foreign trade policy there is an end date, but for this foreign trade policy there is no end date, so therefore they can continue till the time they want it. And basically this foreign trade policy is for the purpose of encouraging exports and regulating imports. And this foreign trade policy is given by DGFT, Directorate General of Foreign Trade, and who will be under Ministry of Commerce and Trade, and Foreign Trade Regulation and Development Act empowers the ministry to give this foreign trade policy. And this foreign trade policy will have basic policy plus export incentives. And how imports and exports are classified? It is classified into 4 as per FTP. Prohibited, you cannot import it or export it. Restricted, you can import it or export it only with a license called as authorization. Reserved for state trading enterprises, only state trading enterprises can import or export it. Then freely importable or exportable means any person can import it or export it, no need of any license. So that one. And next, what is the difference between FTP and customs? So FTP is the brain of the international trade to decide what to import and what to export. Customs, GST and other laws is the body of international trade to decide, like how to import or how to export. And then we have another area, like what are the recognitions under FTP? We have 3: authorized economic operator, towns of export excellence, and status holder. So this can be asked a short note question. Authorized economic operator program, wherein so they will be given a status as authorized economic operator, and they will get these benefits. What are these benefits? Preferential bids. Remember preferential bids. Preferential customs treatment in terms of reduced examination and faster processing. Then border clearance privileges in case of mutual recognition agreement in partner countries. So when they export it, they get the preferences there. Enhanced port delivery, deferred payment of customs duty, and they can self-certify that these goods are manufactured in India. So that is about authorized economic operator. And towns of export excellence means some towns will be selected for the purpose of encouraging the exports. So that is this. Then status holder. Status holder is depending upon their export performance they will be giving. So you need to remember these numbers. So 1-star export house $3 million, 2-star export house $15 million. So 3, 15, then 3 star 50, then 4 star 200, 5 star 800. These numbers you need to remember: 3, 15, 50, 3, 15, 50, 200 and 800. Okay, so this is the export. Whenever they achieve this, they will be getting this star status. And what are the benefits to the star holders? So status holders: wipes made in India exempted. What is that wipes? Warehouse license. W refers to warehouse license, but to which one? 2 star and above. 2 star and above will get the warehouse license, means they can establish their own warehouse. Then I, input output norms on priority, that is within 60 days. Then P, preferential treatment and priority in handling. Then E, export free of cost, except gems and jewelry, they can export it free of cost. Then yes, self-declaration as to made in India. So then self-declaration with respect to authorization and made in India self-declaration for 3 star and above, and they are exempted from furnishing bank guarantee. So that is about this. And how to calculate the export performance? We need to take export performance based on current year and previous 3 years foreign exchange realized. Current and previous 3 years foreign exchange realized. For gem and jewelry sector, current and previous 2 years. And export performance is necessary in all 3 preceding financial years. All 3 preceding financial years, they need to achieve this. Then only they will be given this star status. And for giving the 1 star export house status, double weightage will be given for few people. Micro, small and medium enterprises, manufacturing units having BIS or ISO certification, units located in northeastern state including Sikkim, then Kashmir and Ladakh, then export of fruits and vegetables. This is that. And next we have specific provisions. So these are all the important areas. Okay, even though I posted already a video on FTP, but some students asked me, that's why I'm quickly revising some important concepts in this. Then specific provisions related to import and export. Mainly this gifts point can be tested. So what is that? Import or export of gifts. In case of import of gifts, is it through post or courier? Yes. So Rakhi or life-saving medicines do not require authorization. Any other goods prohibited that cannot be imported. If it is other modes, yes, authorization not required, freely it can be imported. In case of export of gifts, restricted goods, authorization required. Freely exportable goods, if the value does not exceed 5 lakhs in a financial year, authorization not required. Otherwise, authorization required even though it is freely exportable goods. Then next, second-hand goods point also can be tested. Import of capital goods, which are second-hand goods. What are they? Air conditioners, then generator, desktop, refurbished or reconditioned spares of computers or laptops or notified electronic goods that require authorization. Other capital goods do not require authorization, and if it is reconditioned or refurbished spares of such goods, provided the life is at least 80% of the original life. Remaining second-hand capital goods, so authorization not required. Other than capital goods, normal goods, if it is imported for the purpose of repair, refurbishing, authorization not required, otherwise authorization is required. Then next, we will be required to know about these export promotion schemes. Export promotion schemes, at least from there, you watch the video completely. Up to this, whatever we have seen, enough, like this important concepts, at least from export promotion schemes. So please watch that video completely, please, I request you. So that is hardly like export promotion schemes alone will be 1 hour, because there I cannot reduce it. If I reduce it, I need to dilute it. I don't want to do that. Up to this, I told you what all the important areas to be seen. But at least from various export promotion schemes, see that detailedly, please. It's already there in the video. From this place onwards, fully you see once, you watch it in 1.5 speed or 1.8 speed and listen once, because no, you are thinking that I can explain everything and that will be sufficient. No, don't do that, because my heart is not agreeing to it. If I need to complete it in lesser time, then I need to dilute it. I don't want to do that, because it's a new FTP. They can ask it from any nook and corner, this export promotion scheme. So this alone, please watch and go. Okay. Then, so how much time we can take for revision of C category topics? C category topics, just you see, like already I told you in the revision plan itself. So based on that you follow. Please check the revision plan once. Please share the important time limits, circulars, rules which are to be quoted. Already I gave the website details, so it is there. Summary of time limit, summary of monetary limits, and circulars you don't have to quote. Circulars you don't have to quote, just write as per CBIC circular. That will be sufficient. Okay. Fine. And this is what you need to do. And just follow this, whatever I have given. I don't want to waste your time further. And we will be I will be available in the Telegram. So whatever doubts you have, till the time tomorrow you go for the exam, I am available in the Telegram. So in the Telegram, already some students are asking the doubts, I am replying. So I am not I have devoted only today evening I have the lecture. Today evening from 6:15 to 8:45, 9 o'clock like that I have lecture. Apart from that, I am all yours. Whatever doubts you have, immediately I will be able to reply to your queries. So you put it in a Telegram and even voice message or somehow I will try to convey that to you. Okay. Thank you all. So all the very best for your exam for tomorrow. Take care and do well. Okay. Thank you. Then if there is any queries, you can just put it now also so that we can complete it in the YouTube live also. If you have any queries for some time. Sir, taxable and event under GST, how to revise? Rocket revision video is for 6 hours. You do one thing, you don't watch this November 23, you watch the May 23 video. Taxable event under GST, if you are not able to watch this, so you watch the May 23 video. In that May 23 video, you see the taxable event. So that will be for a lesser time, you can see that. Okay. Because last time students asked to explain it in detail. That's why I explained it in detail. Then Rule 43 already I explained in this video itself. Please check. Then body corporate including LLP. No, body corporate under GST do not include LLP. LLP will be treated as firm under GST. Body corporate is private limited company, public limited company, or any body under any law for the time being in force, like RBI, SEBI, IRDA, like that, even ICI. So, but LLP will not come under body corporate. It will be treated as firm under GST. Okay. Then business entity means any person engaged in business. So it includes sole proprietor also, partnership also. Everyone will come under business entity. They should be engaged in business. Sir, assuming the question is silent, okay. And yes, thank you. Take care.